Do you have to pay your whole life with whole life insurance? It is a whole life insurance policy, often where premiums are payable until age 121, 100, or maybe I'm looking at a limited pay product like a 10 pay. Whatever it is, if it is a permanent life insurance policy or a whole life insurance policy, does that mean that premiums are payable for your whole life? The answer is no, not at all. You can easily design a policy where we fund it for a very, very short period of time or pay forever if we choose to do so. The thing is, we like options. How do I have the option to fund the policy forever if I wanted to? So if you said, hey, my goal is to optimize cash value, but I want to continue to feed this policy to grow that death benefit to the largest figure possible. This way I can leave a large legacy or inheritance to my family, to my beneficiaries. Funding a policy forever will help accomplish that. Maybe your goal is only to fund it for a few years. Have you ever felt like, hey, I love the benefits of a cash value life insurance product. When I focus on the cash value, safe, liquid, tax-free area to position money. I've got access to it. A unique loan feature where my money always stays at work for me, but I don't want to have to make payments forever. Like after 10 years, like I'd like to pay into it for 10 years, maybe 5 years to a certain age, and then be done. Well, you've got an option to do that. And then, option to adjust as you go. That's the beauty right there. Meaning, if I want the ability to fund forever or stop funding after a short period of time, is that something that I always have to determine up front? I've got to state, hey, when I start a policy, this is the plan, this is the course I set on. No, you can adjust it. You can make the policy very flexible to adjust as you go the funding time period. This way, if life happens and I've got to stop paying into it very, very early, I can do so. If you design the policy to be very, very flexible, aside from just the time period, as far as how long we can pay into it, you can also design the policy where we can make it very flexible. Flexibility is key, meaning if I want the ability to pay in $20,000 per year, maybe it's $200,000 per year, whatever that dollar figure is, that's how much I'd like to be able to get into the policy each year. But boy, I don't want to get a bill for that high dollar amount. Have you ever felt like that? Well, you can design a life insurance policy to be very flexible where we commit to a minimum premium and then have the ability to pour excess funds into the policy at our discretion. Some things we've heard over the years, among many things I've heard, is one, I don't want to pay forever. I like this policy, but I've got to pay premiums forever. If that's the case, it's not for me. Even if the premium is minimized, I like the idea of stopping payments early. I have a lump sum. I want to get that lump sum of money into a policy and that be it. After I move, say it's $1 million into a policy, like I don't want to have to pay anything. If I have the option to continue to pay, and if I choose to continue to do so, all right, sign me up. But boy, I better not continue to get billed or be obligated to make premium payments. Ever felt like that? And then the last one, I want income in 10 years, or I want access to the cash value quickly, whatever it might be. These are all possible. The thing is, how do I take a life insurance policy, a whole life policy, which is traditionally what? An insurance policy. How do I take an insurance policy and make it extremely flexible where I can use it as a flexible savings asset? This way, I'm not obligated or committed to this huge bill or committed to making payments forever. If I've got a 401k and I'm building my retirement savings through that 401k or any savings instrument, if I lose my job, if I'm laid off, I'm not required to keep making contributions to that 401k. So I don't want the life insurance policy to feel like a burden if that happened. So again, the nice thing is, if the policy is designed properly, you've got all the flexibility in the world. Let's take a look. Let's have some fun. So, a lot of charts here, but what I'm going to add before we start looking at the numbers is this is all one policy. Same policy, same design on a 40-year-old male, just different funding examples. So 40-year-old male, same policy, same company, same health rating, minimum premium $2,000, and a MEC limit of just over $20,000. It's about $21,000. That MEC limit is the maximum amount of money we can pay into the policy per year without triggering a taxable event. So again, these are all the same policy. The difference is one model on the far right shows what it looks like if he funds it for 30 years, up until he is 70 years old. We can scroll there, but paying in for a long period of time. And then as you look to the examples on the left, we see an example where he funds for 20 years, 10 years, 5 years, and look at this, 2 years. If life happens and I cannot pay anymore, zero, I'm not even paying the minimum premium. When you see annual outlay, zero, this represents a net out of pocket of zero. And this is pulled directly from the insurance company's illustration software. This is based off of present dividend rates, but we like to stress test this based off of guaranteed values as well. But this assumes zero out of pocket, and our cash value continues to grow. So this certainly helps answer the question, do I have to make payments for my whole life? The answer is no, not by any means. And it also, in my opinion, provides peace of mind. If I'm setting up a policy and I want to be able to pay into it for a long period of time, but life happens, I want to know that I'm not obligated to that, and I'm not going to potentially lose my money, and I want to see it. I want to see it firsthand. This is why we put these videos out there. This way we can see it first before talking to people, or maybe you're already engaged, you're talking to us, someone else, whatever it might be. It's information so we can see it. You ever hear the saying, people tend to believe what they can see, not always what they can hear? Well, because it's real. We can see it and feel it. So this is an example of showing funding for different time periods. Now, in respect to the flexibility, we talk about this all the time. The premium component here is $2,000. So you have a premium, a minimum commitment of $2,000 per year, and then you have the ability to go up to $20,000 by adding more money into the PUA component. We've got a small term rider attached as well. We can plow funds into cash value, and this is what accelerates their growth on a policy. This is so important. If life happens and the policy must pay for itself, it has to pay for not the full $20,000 bill, but the minimum base premium of $2,000 in this example. Whatever our policy size is, that would be the case. And that's important to be aware of. If I go with a very high base premium and life happens, the policy has to satisfy that high base premium, unless I've got enough MEC space where I can reduce it. But I'm going to try not to get too technical here. So an example of not having to fund it for your whole life. The other question, a lot of people ask this, is, hey, do I have to fund it for my whole life because I've got a lump sum of money and I do not want to have to continue to fund it. I've got a lump sum. We mentioned $1 million example earlier. I'm going to move that money in, and that's it. Here we've got a 40-year-old male. This could be a 60 or even a 75-year-old male if we wanted to. It could work male or female, but we could optimize the cash value. And here's where it gets fun. Guaranteed values demonstrate an absolute worst case scenario. So one, it assumes no dividends are ever paid to the policy. We only earn the guaranteed rate, which companies never only paid the guaranteed rate indefinitely. I should say the major mutual companies we recommend have never done that. And it also assumes that all riders and charges are at the maximum allowable rate that the company can charge if they want to. So talk about worst case scenario, this is it. But even with that said, what do we see? $1 million going into a policy over 4 payments, $250,000 per year, nothing thereafter. Cumulative outlay helps us track our break-even point, almost there, year 5. Year 6, we are positive, or where we are over $1 million. And the annual internal rate of return represents what I am earning year over year. So what I always like to relate this to is, if I've got money in the market and it's 2019 through 2020, the S&P 500 produced just about 30%. That's what I earned that year. What did I earn over the past 30 or 50 years or 20 years in the S&P 500? Well, with the ups and downs, I averaged perhaps 8%. Annual internal rate of return isolates that particular year and what I am actually earning. This is the annual. If you're interested in the averages, we've got that in other video content around internal rates of return. Point being though, guaranteed values, just to provide some transparency, when a policy is designed properly, you'll see these type of guaranteed values. If it's not designed that great, that's where you're going to see a break-even point well beyond year 10. If it's designed, you'll see it prior to year 10. Here it's optimal between years 5 and 6 on the guarantees. Current rate values, $250 per year. Break-even point, now between years 3 and 4. Exact same policy, same insurance company, same design, pulled everything directly from the insurance company software like we always do. Everything's the same, but the present assumptions. Stronger performance, because they're actually paying a surplus. Growth looks good. And again, going back to the original question, do I have to make payments for my whole life? No, not at all. We can if we want to, but here we've got nothing going in at all. Got to keep it fun. So, hope this helps. If you have any questions or would like to see any customized samples like this, feel free to reach out anytime, and we'll talk to you soon. Have a great day. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.